So from Wall Street to Main Street, winter is coming. The Dow erasing all of its earlier gains today as we went into the close, and that just added on to this sell-off and a steep two-day decline that we'd already seen this week. On top of that, economists at Goldman Sachs and J.P. Morgan warning of a growth slowdown next year. So what's next? Glenn Hubbard joins us, Columbia Business School Dean, also the former Council of Economic Advisors Chairman under President George W. Bush. Good to see you, sir. The Goldman report and the J.P. Morgan report basically said next year we have maybe a little above 2% growth first half of the year, a little below 2% growth the second half of the year, I believe. What do you think next year will look like?
Well, I think the forces to look at are what do you think is going to happen to oil prices, to monetary policy, and to the trade policy discussions that are going on. There are scenarios that could get you to the slow growth in the 2% range, but I could also see higher growth if the Fed does its normalization right, if trade policy normalizes, and the oil price stabilizes. So it really depends. I think part of what has weighed on the stock market right now has been the decline in oil prices. There's been a pretty robust correlation between oil price changes and S&P 500 changes.
A couple of things, well, I guess three things that you mentioned there to take apart. But let me try to do it one by one if we can, because it plays into what the president's been saying this week and been saying over time. So for context, for people that know your past experience, you were in Kevin Hassett's job. And people watch, he comes on this network a lot. And, you know, Larry Kudlow does as well. But you were in Kevin Hassett's job for Bush 43, right? So
yes.
If you were in that position now and the president were approaching a meeting, as this president is, with the president of China at the G20, what would you advise him is the best course of action to take economically?
Well, I think what the president needs to do is ask first what America could be doing itself to get its own house in order with respect to China. You know, China has its own strategies. We should have ours, too. But I think the president needs to get quickly to the core issues, which have little to do with the bilateral trade deficit and a lot to do with intellectual property protection. Right. I think there's a good deal to be had, and I hope the White House is on that path.
Would you tell him, though, point blank, Mr. President, cut some sort of a deal if you want to get reelected in 2020?
Well, I can't give any politician advice on being reelected. They're the people who get the votes, not economists like me. But what I could say is that a good trade deal is definitely in the interest of the nation, in the interest of all of our citizens, and that's the reason he should do it.
All right. What about oil? Because that's the other thing the president's talked a lot about it. The Saudi Arabia back and forth this week, and some of his tweets, even one we mentioned earlier this hour where he was openly rooting for oil prices to continue to decline. But it seemed to be, from your earlier comments, I'm reading into that, would not be such a good thing for the economy.
Well, not so fast. I mean, what I said was oil price declines are associated with a near-term decline in the stock market. The U.S. isn't the U.S. of 30 or 40 years ago. We have a lot of investment in energy and in oil production. Having said that, I think a lot of what is going on in the oil market has as much to do with supply as it does demand. One thing that is worrying people is this a fall in demand because people think the economy is not going to grow? I think really it's a supply shift, and the market may be overreacting. Okay,
that's interesting because it plays into what Saudi Arabia, who the president may have been trying to pressure to not cut oil production, what they will actually do. They still might go ahead and cut oil production because that speaks to the oversupply issue, right?
Right. They may find it in their own interest to do that.
Yeah. I want to get a kind of a broad macro view, if I can, from you for what factors might lead to the consensus being wrong for next year. We've talked, sometimes we, I think, tend to focus too much on the negative, but I've asked you already about what the headwinds could be, and you've talked about what some of those could be. If those people who are predicting a slowdown are wrong, what has to happen? What would get us back on a better growth trajectory?
Well, a couple things. One, the labor market is still quite hot. I think when the Fed is looking at the economy, that's what it's focused on, and that's still extremely robust. The second is business investment. We saw a snapback in business investment after the Tax Cut and Jobs Act, and then CEOs started to worry a little bit as the trade discussions happened and concerns about global growth. I think really what's worrying people is what is long-term growth in the United States? Do we have a positive growth future or a less positive one? I think when business people sort that out, the markets and the economy will respond. Unfortunately, some of the rhetoric in Washington really muddies the water. The trade wars, criticism of the Federal Reserve, that's really not what's going to bolster expectations.
Right. So the president, and real quick on the Federal Reserve, you expect an aggressive Federal Reserve no matter what rate, in hiking rates next year? This will be the final question.
I wouldn't call it aggressive. I think the Fed will do what it's right in normalization. I think the Fed is looking at the economy just like everyone else.
Yep.
It had been a little bit behind. Now it's caught up.